But let's go into the stocks because we've got to get down the list. Growthpoint, let's talk about them. They're the biggest of the lot, emerged from the Investec stable. I think people know that. They've got properties across South Africa, Australia. They've got an interest there. And some of their big flagship properties in this market include those such as the V&A Waterfront in Cape Town. That's a sparkler. Market capitalization, 71 billion rand. So there we go, pretty solid and substantial in the index and all of the important contributing sector and all the 40 type stuff. Dividends that it produces by way of those distributions amount to probably, these are historic numbers we're reading, and that's 4.96. So that reflects the compression of yield that Wayne was talking about. Let's have a look at the share chart. So that's what it would look like if you'd owned them over the last 5 years. They've crawled upwards slightly, reflecting, you know, the resurgent growth of the South African economy, maybe a bit of a question mark at the end there, and the tailwinds that Wayne talked about as they've internationalized their model. Wayne, specific comments about Growthpoint?
Look, I mean, obviously this is the biggest. Yeah, this is the biggest one. It's got 100 billion rands worth of assets. So that must be a good 1/3 of all the listed property assets.
And their gearing, in other words, they would have 100 billion worth of profits, about 30 to 35% debt in there, where the buildings are obviously the collateral.
All of the listed companies have got about between 30 and 40% debt.
Important point to
note.
It's
the only way you actually get a decent growth in distribution. It's very, very difficult to get proper distribution growth.
And that's all bank finance and a bunch of different
lots of guys issue their own paper.
Okay.
A lot of guys issue their own paper, but there is a lot of bank financing. And when you read through the financials, virtually 100% of it is the interest rate is fixed. Either in the loan itself or they take out derivative instruments to fix the interest rate. So they will be relatively unscathed by long bond rates going
up. At least in terms of their
in the
cash
shorter
flows.
term, yes.
Okay.
But look, the thing is, you're buying it at a 5% dividend yield. The last distribution growth was 7%, and they've advised us that this year they don't think it's going to be more than 5 or 6% growth. Okay. So you're buying something at a 5% dividend yield that's going to grow by 5 or 6%. You've got a long way to go to reach an 8.5 government bond rate. And this is the lowest it's been. So, I mean, once again, coming back to the point, it's very expensive.
Right. So we're going to go quite quickly to hot or not because we did such a lot of waffling at the front there that we've got to be quite tight on the stocks. But my question really then is, what you're saying is, as far as your current personal perspective is concerned, if you were just an ordinary citizen at home with an ordinary small cap portfolio or small value portfolio, you wouldn't be rushing in to buy these now. That's fine, good and well. So we're probably going to be not hot on the portfolio picks as it stands. But as far as somebody who owns these things and has owned them for their yield and distributions, you've done well, you've done fine.
If you bought it at the right price, that's fine. Just don't buy more now. That's the whole point. If you're sitting as a conservative investor and you're thinking listed property or bonds, forget other shares, you must buy bonds. They're better value.
And as far as the calculation that a long-term investor who's had them for a while concerned, they can just look at their own purchase price. And they can say, well, look, I'm getting X number of rands on these things, I'm doing well.
You're doing well, yes.
Okay, but as far as the current status is concerned, you're going not hot.
Yes.